I'm Grant Williams. About a month ago in Things That Make You Go, I wrote a report called Car Trouble about the US auto industry. And I wanted to flesh that story out for you today because it's something that is happening right now, and it's a lot bigger story than people think. To do this, I'm going to enlist the help of a couple of people. Daniel Ruiz, a fantastic auto analyst from a company called Blinders Off, who presents an incredible amount of information and digs really deep into the sector. And my good friend Michael Lewitt, who's a person I spend a lot of time talking to about this particular industry because he follows it very, very closely. We're going to give you a sense of what's going on, give you a sense of where the problems lie, how big they are, and at the end, hopefully a few ideas as to how you might profit from it. The US auto industry is a big deal. It represents 3% of US GDP and it employs roughly 5% of the total workforce in the United States. In the last 6 years, $775 billion of exports of cars and auto parts have left the United States, making it by far the biggest export sector. There's number two is aerospace, which is a distant $125 billion behind it. On a global basis, research and development in the auto industry is the second biggest sector of 40 sectors measured worldwide. It really is a big deal, not just in the United States, but beyond. Car sales have been rising now for some 6 straight years, ever since cash for clunkers was instituted in 2010. And that's been a huge benefit for the industry as a whole. It gave the auto industry a $3 billion jumpstart when it needed it most back in the depths of the post-Great Recession period. But what it's actually done is pulled forward a hell of a lot of demand. And we're at the point now where we're seeing the backside of that demand, and the missing purchases that have all been made in the last 6 years are starting to be felt. Throw in the fact that in the era of cheap money, you've had this surge of people looking to borrow money to buy cars at really low interest rates, and you've seen auto loans balloon to over $1 trillion now. That's way higher than they were before the credit crisis. In amongst those $1 trillion, the fastest growing sector, I hate to say it, is once again subprime. And while the subprime sector is not as big a problem on a wider basis as mortgages were back in 2007, 2008, the 2015 series of subprime auto originations are forecast to see the biggest delinquencies of any tranche before that, with default rates projected to hit 15%. That's a major problem. Kicking things off is Daniel Ruiz. And Daniel starts by looking at a sector of the market that perhaps is not intuitive to most of us. He goes straight for the used car sector. And there's a really good set of reasons for that, and Daniel's going to lay them out for you right now.
I'm going to start with used car values, which really, in my opinion, is the foundation of the entire automotive industry. And one chart that's gotten a lot of popularity lately is the NADA Used Vehicle Price Index. It's been falling significantly, and because of that decline, we've had a lot of attention on used car values. It's probably best that I start at the beginning, which is, what happened during the last recession? Because used car values fell significantly, during the last recession. But something else happened, and I want to talk more about the recovery and why we've had the results that we've had in the automotive industry, with last year being a record-setting year, and so was the previous year. Used car values have rebounded really, really sharply since the recession. That was largely in part because new car sales volume was very, very low during the recession. Used car is nothing more than a new car once it rolls over the curb. So we had a really, really short supply of pre-owned cars coming out of the recession. The government stimulated the automotive industry with what we all know as cash for clunkers. Great program, stimulated sales. We had a huge spike in volume of new cars sold. But used car supply was actually starved because those sales did not produce trades. So we actually took trade-ins out of the equation with cash for clunkers and further starved used car supply. Since then, we've enjoyed what I would consider are extremely short trade cycles. So I'm going to start with the why. Why are we seeing the things that we're seeing? Why are we reading about the negative effects that falling used car values are having? We've all become very familiar with the NADA Used Car Value Index. I'm going to explain why it relates to higher delinquency rates in subprime, why auto loan originations are falling, and why there's been a divergence between auto incentives and sales volume. Typically, the more manufacturers support cars with incentives, the more cars they sell, but that's not been the case. We've now missed new car comparisons 4 months in a row despite a higher incentive spend. So again, why is this happening? It all relates to used car values. The simple answer is, as used car values fall, it has a lot of impact on all the things that we've just talked about. And there's a lot of negative equity out there. So that's at the core of things. And I truly believe that used car values are the foundation for the entire automotive industry. I'm going to start with talking about trade cycles, because I think that's something that's at the core of this. We've enjoyed really, really great sales numbers for a long time. And the reason why is because we've had extremely short trade cycles. When used car values are really outperforming as they did shortly after the recession, it allows dealerships to trade folks out of cars a lot quicker. An optimal trade cycle happens when the principal balance owed on a car meets the current market value of that vehicle. At the point where there is no inequity, or when you're in an equitable position. That allows an easy transition from the car that you currently own to that new car that you may consider purchasing. So for years, we had a very, very strong and very short trade cycle. Customers would come into a car dealership for an oil change, and it was a very, very easy thing for a salesperson to walk up and say, hey, would you like a new one? Would you like a different color? Would you like something with the newest upgrades? And by the way, your payment's not going to go up because you have equity in your car, and we really need it. So it was a very, very easy transaction for quite a long time. But things have changed. The effect of falling used car values takes that out of the equation. Trade cycles are extremely important. The vast majority of new car sales involve a trade-in. If we're bringing our cars back quicker, that has a direct effect on sales velocity of new cars. The shorter the trade cycle, the higher the sales velocity of new cars. The longer the trade cycle, the slower the velocity of new cars. What caused used car values to fall? What was the correction? What happened? It's important to understand the effect that leases have on used car values. As a used car manager working at a car dealership, you have to consider quite a few things when you're trading in a vehicle. How am I going to market the vehicle? How am I going to sell the car? Where am I going to price the vehicle? Who's my competition in my local market? Something that needs to be of big consideration is that used cars always have to have a value proposition to a new car. And what most consumers measure as value is their monthly payments. There has to be a good reason for buying something that may not be the perfect color, that might have some miles and some wear and tear, that's had some usage. And the reason why folks buy pre-owned cars is because they present a better value in terms of monthly payments than new cars. Well, when leasing gets to a certain level, and really to extremes, which we've seen, where cars are, $50,000 cars are leasing in the mid $400 range, that puts a really, really significant downward pressure on used car values. Used car managers really have to figure, how am I going to market this car to a potential customer? How am I going to justify the payment compared to a potential lease on a new car? It leaves you in a situation where if you have a $45,000 car and somebody wants to trade it 1 year later, is a $10,000 depreciation enough? Is a $15,000 depreciation enough? $400 is a $20,000 loan. And when you have $50,000 cars that are leasing for $400 or $500 per month, there's no market for that 1-year-old car. There's no market for the 2-year-old car. And it puts significant pressure on all vehicles that are pre-owned.
I think when most of us think about the auto sector, we instinctively think about new cars. You drive down the street and see dealer lot after dealer lot filled to the brim with shiny new cars. But as Daniel points out, it's the used car market that really has a massive effect on the overall industry. And the undercurrents that Daniel lays out are really quite surprising. I was taken aback with just how serious they are when you look into it. And it illustrates perfectly the knock-on effect, which is something we try and talk about at Real Vision all the time. To get another perspective on the auto industry, I wanted to call my friend Michael Lewitt. Michael is someone that I rely on when I'm thinking about this and trying to get my head around it, because he looks at this stuff all the time. He's one of the best credit writers out there. He writes the Credit Strategist. So I sat down with Michael for a chat to get his perspective on the auto industry. Okay, well, when we were putting the story together about the auto sector, one of the first people I thought of, Michael, was you, because over the years you have been one of the people that I've relied on to keep me current on the state of play in the auto sector. So I wanted to bring you in and get your thoughts on where we are on the timeline for this whole thing playing out.
Right now you have retail suffering from a real structural shift that's clearly having an impact not only on the industry but on the economy, on employment, everything else. And I think autos are the next industry, just like retail. A lot of it is technology driven through Amazon. I think autos are the next. I think autos have one advantage. They were not sunk by private equity firms coming in and loading them down with debt. They don't have that problem, although they still have significant healthcare and legacy obligations left over from their bankruptcies.
Michael makes a great point tying in the auto industry to the retail sector and the US consumer. It's a very important linkage to make. The US consumer is 70% of the economy, and so it's vital to understand what's happening to the US consumer. Michael takes a typical credit guy's look at the auto companies, and his point that they're not weighed down by the debt strapped onto them by private equity is important, because with that they'd be in even more trouble. But it's clear that as the US consumer comes under pressure, the auto industry is going to be one of the sectors that suffers the most.
The overall industry, I think, is probably going to see, at least in the US, lower volumes. I mean, China and other places is a whole other issue. But there's clearly secular change coming, and it's going to have major impact on the US economy. While we're talking about what's already happened to the manufacturing economy in the US, and there's been some positive signs because of the recovery of GM and Ford and so on, I think we're now going to see another potential leg down. If the volumes, which are now like 17, 18 million a year, fueled by a lot of subprime auto loans and so on, are going to fade. I mean, right now we're at peak inventories, we're at peak subprime loans, we're at levels that are not sustainable. So you're also going to have to deal with that it's unlikely that these levels are going to continue in a 2% growth economy. So you have
that's something I wanted to dig into with you, because if you look at this, these companies, they have pulled forward a lot of demand, going all the way back to cash for clunkers. They've managed to have rising sales for 7 straight years now after that. But the last 4 months, we've seen that turn. You've started to see auto sales decline, and most worryingly, perhaps truck sales, which, as the price of gas came down. So if you add that, you add the massive amount of inventories on dealer forecourts, which is at levels, I don't think the data goes back to the 80s. We haven't never been anywhere close to this. And the subprime trade. Your 3 to 5 year timeline, I'm interested to see how you see that playing out, because when you look at how important the US auto industry is to US GDP, it's 3% of GDP and employs 5% of the workforce, I think. It's something that they can't allow to be in trouble, kind of thing. You know what I mean? So
well, 3 to 5 years. I don't mean to interrupt. 3 to 5 years is what I'm talking about. Is the beginning of real secular structural change.
Yeah.
I'm not talking about the cyclical change, the turn in the market. Inventories are at record highs. There are record numbers of cars coming off leases. Used car prices are dropping sharply. The average age, I still think the average age of the fleet is over 11 years, if I'm not mistaken. It's, people keep their cars longer. I keep hearing about the strength of the consumer. I think that's one of the great fairy tales. The consumer is still dealing with epically high and rising healthcare costs. The healthcare system is failing, and even if they come up with a solution to Obamacare, it's going to take at least a 3-year sort of turnover. to fix it. So people don't have, they're not, they're borrowing money to buy these cars. And so, you have over $1 trillion of subprime loans, all this other stuff. And the Fed is raising rates. They're still very low. But, you have a situation where it may not be 3 to 5 years until you start seeing the numbers of cars manufactured and so on get reduced. And that would be coincident with other things we're seeing that suggest that a recession is a real possibility. The yield curve is inverting. It gets flatter every day. The Fed's going to raise rates later today unless a meteor hits the world, and so the shorter end's likely to move up further. I don't see the long end this morning. I thought I was misreading. The 10-year was at 213, which really shocked me. It was just a 220 just last Friday and Monday. The curve is flattening, so you have all these indicia that show you that the economy is not growing and that we're likely heading towards slower conditions. And autos are right in the heart of that. So I think that when you have sort of what I call cyclical conditions combining with secular conditions or structural conditions that are all negative, that's not good. And I think, in fairness, I think the auto industry needs to be commended because it is, definitely trying to get ahead of the curve on the technology side and everything. But on the sales side, it's doing the same old stuff, which is, incentives and all this stuff. And then, the lenders are just, making money available. But money is getting cheaper. I mean, remember, auto loans are on the shorter end of the curve, and that's the side that's going up. Now, it's still very low, but it'll end up being a problem, and you'll see defaults rise and everything. Now, I don't view auto loans as a threat to the economy the way housing was. It's just not. You can walk away from your car. You can't walk away from your house as easily.
Sure.
But it's going to be a problem. And I think that time frame is shorter than 3 years because you're just seeing it coincide with other signs that the economy is moving, is just sort of slowing down.
We'll come back to Michael later, but what I want to do now is switch the focus, go back to Daniel and get his thoughts on the leasing and securitization of the auto industry, which plays a big part in trying to understand, again, these cross currents that are forced upon the industry by securitization and finance. So let's get Daniel back in and hear his thoughts on the lease market.
Another thing to consider is the level of negative equity that we have in leases today. Active leases that have not matured yet. Credit risk on a lease is very different than credit risk on a regular automobile loan. Losses happen on regular automobile loans when they default. How much was owed? What was the balance on the vehicle? And how much did we recover when we sent the vehicle to auction? But they require that default in order to realize those losses. With leasing, you introduced residual risk. A lease does not have to default in order for a captive bank to lose money on the transaction. It just has to mature. And what's concerning is the level to which these loans have been securitized. An auto lease asset-backed security is a thing. And it adds a layer of complexity that really needs to be looked into. The level to which loans have been securitized is back to the peaks before the recession. And it's very understandable because for years, used car values outperformed residual values. So as these leases matured, the clients, it was never a risk to the captive bank or the bondholder. When leases mature and they have equity, it's a huge boost to new car sales because the equity can be used towards a down payment. The customer rarely ever returns the car. They'll choose to buy it before returning it because they want that built-in equity, and they look at it as a value. It's only when used car values start underperforming residual values that we need to become concerned. And this is what concerns me about these securitized loans and leases. It's needless to say that the amount of residual losses that are currently on the books, unrealized, is significant. There are over 10 million leases outstanding, and for every $1,000 that these captive banks miss that residual calculation by, every $1,000 represents $10 billion. So now I'm going to focus on GM because they have the largest day supply out there right now as far as manufacturers, and their response has been the most extreme in my opinion. I was concerned that if we missed sales figures in April, manufacturers were going to respond by raising incentives pretty aggressively because we're so close to the time of the year where we have to get rid of leftover product. Higher incentives is exactly what we got. They responded to their day supply problem very aggressively with a very, very low lease payment on a Silverado and a 20% reduction from MSRP on a Chevrolet Malibu. One has to consider what the direct effect of that level of discounting is going to be on used car values. What's a 1-year-old Silverado worth today? A 2-year-old Silverado? If you're taking 20% off on a new Malibu, how much do you have to discount that 1 or 2-year-old Malibu so that if you try to retail it, there's some sort of a value proposition to the new car?
As buyers of cars, we look out for incentives and we like them to be as big as they possibly can be in order to get us a discount on that shiny new car. But when Daniel talks about the incentives and what the dealers are having to do to try and shift some of this massive inventory overhang, you start to think of it in a different way. And this notion of incentives and the degree to which they're becoming increasingly more important to the manufacturers is something that Michael and I spoke about on our call. You know, the incentives now are at all-time highs. I think $4,000. I heard an advert on the radio this past week advertising $14,000 off a Dodge Ram truck, which and I was trying to figure out what a Dodge Ram truck must cost, and that's got to be 30% discount on that thing, or 20%.
Yeah, the incentives are crazy because the lots are full. I mean, driving around South Florida, the lots are full, and there are only so many people for so many cars. There are a lot of immigrants down here. There are a lot of immigrants in the U.S. But now there are fewer immigrants in the U.S. So if the population stops growing from that segment, they're not gonna be getting cars. So I think that the industry is running up against it, and they're trying to deal with it in the traditional way on the sales side, on the non-traditional way with the technology and everything. But it's not going to be a smooth transition.
Yeah, that commercial I heard on the radio with the big discount for the Dodge truck, when I heard it, I was astounded at the sheer size of the discount. But Daniel makes that great point that this is something that once it starts, this is a set of dominoes that just keeps toppling. And as GM cuts prices, so Ford have to cut prices, so Chevy cut prices, and the dominoes just keep cascading. And this is really just starting to get going now. So it's a great time to be a buyer of a car because of the incentives you're going to get offered, but it may not be such a great time to be a buyer of the stocks of the automakers.
Another thing to consider is that when one manufacturer has a day supply problem, like GM for example, the other manufacturers don't rest while they get their house in order. The auto industry is very, very competitive. Anyone that competes directly with GM is going to adjust in order to not lose market share. So the heavy discounting becomes contagious, and the unintended collateral damage is used car values. This is all happening at a very bad time, and it's why I consider this to be the perfect storm for used car value declines. There's such heavy emphasis on new car incentives to deal with this day supply problem, and it's putting such enormous pressure on used cars, and the timing couldn't be worse. Something that I'm keeping an eye on that is extremely concerning to me is the amount of 2016 leftovers that we have in May of 2017. Pick your favorite search engine for vehicles. Plug in 2016 new cars at any distance, and you will be amazed at how many vehicles we have available, and we're halfway into 2017. This is extremely alarming, and the reason why is because 2016s represent the most heavily discounted portion of new car inventory. And these cars aren't selling. It's a very strong indication that demand has fallen for new vehicles. Dealers put a lot of emphasis on making sure that new vehicles never roll into the next model year. And the reason why is because at a certain point in time, a manufacturer will stop supporting leftover models. They'll simply make a lump sum payment to the dealership, and at that point it becomes their problem. This makes the 2016s that are left over today extremely difficult to sell because they're competing against the heavy incentives on the 2017s. In a lot of cases, it's less expensive from a payment standpoint, to purchase a new 2017 versus a heavily discounted 2016. I look at the 2016 leftovers like plaque that builds in an artery. They're just slowing things down, and you have to wonder how many 2017s are going to be left over. Once enough of these cars pile up, the patient has a heart attack. You have to stop production. So perhaps you've seen the chart from Morgan Stanley Research projecting as much as a 50% decline in used car values in the next 2 years. When I first saw the chart, I just simply could not believe that something like that would be possible, knowing full well that we have a perfect storm that would make that scenario very, very likely. We have a day supply problem from new car manufacturers that's putting a massive amount of pressure on used car values ahead of a huge supply problem from lease maturities. And the leases are going to go to auction because they have negative equity. We also have the potential for more supply from subprime loan defaults. There's a recent report that Santander, one of the largest subprime lenders out there, only verified income on 8% of their customers. This is extremely concerning to me. It's because the subprime lending industry is also extremely competitive. When somebody walks into a dealership, they want to purchase a car and they have bad credit, their application gets sent to multiple banks. The responses are then reviewed and the most appealing terms are selected. The most appealing terms are not always interest rate. Oftentimes, the approval that has the least amount of stipulations, the one that has the least amount of checks, is the one that's chosen to quicken the sale. If a customer can't provide proof of income, if they can't provide proof of residence, it could delay the sale. There's also a risk that the customer might go to another dealership and purchase from them. The lenders know this, and no income verification is a competitive advantage. Does any of that sound familiar? Taking shortcuts, not verifying things, all in the pursuit of more loan originations? We've been here before. Apparently we haven't learned anything.
Daniel asked exactly the right question. Haven't we learned anything? But unfortunately these days that question always seems to just be rhetorical, because of course we haven't learned anything. We're right back where we are. And all the conditions are in place for another storm along the same lines as we saw in 2008. And although, as I said earlier in the program, the subprime auto sector is a much smaller part of the US economy, the ripples that this can have through a sector that employs 5% of the entire US workforce are seriously, seriously dangerous. So having established all this, having understood where the problems lie, and hopefully given you some sort of sense of the severity of them, what happens next? Where do we go from here? Well, Daniel has a roadmap of his own, which I want to share with you.
What happens next will be a series of events that will have a domino effect. In my opinion, what we'll see next is we've already seen elongated trade cycles in passenger cars. We will now see elongated trade cycles in light pickup trucks and SUVs. The next thing that we're going to experience is an affordability issue, when residuals, which adjust quarterly, continue to fall until they reach equilibrium with used car values. New car sales volume will continue to decline. The day supply at dealers will continue to rise. At some point, dealers will refuse inventory from manufacturers. When that happens, manufacturing will slow or stop while we work through this supply issue. This has a potential to last for a very long time because we not only have a new car supply problem, we also have an inbound used car supply problem. And that used car supply problem is unrelenting until the end of 2019.
So that's how Daniel sees things playing out in the not too distant future. But I wanted to get another perspective, and I wanted to see what Michael thought. And Michael brought up something very, very interesting, and that's the effect that technology is going to have on the car industry. And unfortunately, like all technological change, it's massively deflationary. And for an industry like the auto industry that relies on selling more and more cars every year, that's another headwind that it's going to have to deal with.
Their balance sheets are okay. The issue is they are wrestling with truly historic technological shifts, a double whammy of electric cars, or what I call non-fossil fueled cars, and this driverless car thing. And my mom's a perfect example. My mom is 86, God bless her. She could still drive, but she doesn't like to. So we just gave back her car last week, and she doesn't need it anymore. Between Uber, and if she wanted to get a car, we get her a car that she doesn't have to drive. I mean, that's historic. Otherwise, I got to go schlep and take her everywhere, which I'm happy to do. But that's just a whole segment of the population. And, I live down here in Florida, so, we see all these elderly people driving, which is not a good thing. And it just ripples through. It's number of cars manufactured. It affects the insurance. It affects everything. But I still think it's 3 to 5 years away. But it's 3 to 5 years of, I think, a continuing transition away from the traditional auto manufacturers. And unless they are able to shift, which I think they're doing.
But what does all this mean for us as investors? Michael and Daniel have painted a pretty troubling picture of the US auto industry. And I wanted to ask Michael how he thought this would play out and where we as investors should be looking to try and A, represent the view that's been put forward in this video, and B, the companies and the stocks through which we might be able to make some money out of it. When you think about this and you kind of lay this progression out in your head, where do you think people should be looking for the first sign? Should they be looking at the credit company? Should they be looking at the big three? Should they be looking at the Ali Financials, the Santander, the Subprime auto loans? Where do you think the signs are going to come, and where do you think people should be focusing their attention?
Well, the first thing is I think the big three are sort of dead money. I think that GM is the cheapest stock in the S&P 500,
Yep.
And I think it's going to stay near the bottom. I just think these are deep cyclicals, and they're just not going to go anywhere. That's in my opinion. I mean, it is a cheap stock by every measure, but it's going to stay cheap because of what we've discussed. I think that the problems are going to come. I think that you're going to see rising defaults with the lenders, and they're going to be problematic, and they're just not. They're going to have other problems with consumer loans and everything else. So I think they're, depending on, you have to sort of go granularly, but I think they're in an area that's going to be a problem. What's interesting is everybody looks at the financials and go, oh, well, rates are going up. That's good for the financials. But it doesn't always work out that way because there are other things going on. And then I think the rental car business is going to continue to suffer. And then you have, the auto parts industry and anything ancillary, because if in fact, and we're not, the first wave is going to be just cyclical. The second wave is going to be structural. And when the structural wave comes, it's going to look more like what's happening in retail, where you actually have much lower demand for your product. And then you're going to see the auto parts makers and so on, the AutoZones and Pep Boys and all that stuff. And it's funny, those seem to be real favorites of a lot of the hedge funds. And I wouldn't be surprised to see that money sort of start to exit because the macro picture for them is, it's not there yet, but it's going to start to become problematic. And it's, that's a business that, you look at, one of the reasons the FANG stocks are so popular is because that's sort of the future, future growth is considered very high. I don't see how you make that case for anything auto-related other than possibly Tesla, but that story's so far ahead of itself, it's ridiculous. I think that you're looking at a slowing growth sector that you need to sort of start exiting because it's moving away from the old model to something that we don't know what it's going to look like, but it's not going to look the same.
Okay, so we've covered a lot of ground today, and I want to try and wrap that up for you and give you an overall sense and recap some of the charts we've seen. And the first component of this that I really want to pay attention to is the physical side of it, the cars themselves. You look at auto sales, which as you can see here have rallied strongly since the trough in 2009. We've had 6 straight years of rising sales, but that trend has clearly changed. And you can see it's not just a domestic problem. Domestic cars, imported cars are all seeing declines in sales on a year-on-year basis. And that is a big problem for companies like GM and Ford, for example. Now, Michael Lewitt calls GM and Ford dead money, which means he doesn't expect the stocks to really go anywhere. And that's never a good thing if you're looking to invest in a company. But if you're looking to short something or you see a story with problems, then having stocks that really aren't going to go anywhere is actually a great head start. If you add into the mix the finance arms that GM and Ford have, which could be a source of some trouble for them, as we've seen with the loan numbers, that could give you a good tailwind if you want to have a short in either of those companies. So that's the physical side of the equation. The other component of this is the finance side. And this is where perhaps the problems are going to start manifesting themselves fairly soon. Auto loans in total now are over $1 trillion. And of that, subprime loans have increased rapidly. And we're starting to see delinquency rates rise very, very quickly. That shows the stress that these guys are under because, as Michael pointed out, most of these loans are at the short end of the curve, and that's where the Fed tightening is starting to have its biggest effect. So you can expect to see that contagion spread through. The 2015 series of subprime loans are forecast to hit possibly 15% default rates, which is a significant increase and is going to put some material pressure on companies like Capital One, as you can see here. And another company that you might want to look at is Ali Financial. And the third one may be Credit Acceptance Corporation. But to me, the poster child for all this is Santander. Daniel talked about them only doing due diligence on about 8% of their subprime loans. And when you understand that those subprime loans form 80% of their loan book, you realize what a precarious position they're in and how easily that stress could come to bear on them and cause severe problems for the stock. So there you have it. The US auto sector is a big part of the economy. 3% of the economy employs 5% of the workforce, and it's a major driver of US economic performance. And to me, to Daniel, to Michael, and to many other smart thinkers around the world who are looking at this stuff, the problems are starting to build in that sector, and it looks like a place that's going to come under significant pressure. Hopefully, we've given you a sense of the currents and the dynamics that are going to create that pressure, and we've given you a few ideas as to how you might profit from it.